Creamer Media's Mining Weekly Online is talking to Mohammed Saluji, the Director and Head of Corporate Tax at KPMG. Mohammed, the Davis Committee on Tax has held a session on the current mineral royalty tax regime. Can we expect certain refinements to eventuate as a result of that session?
Martin, thank you very much. You're absolutely right. There was an extensive discussion that took place with various stakeholders and industry players with the Davis Tax Committee towards the tail end of May. And really the purpose of that discussion emanated from certain of the findings that came through from the Davis Tax Committee itself in its first intra-mining tax report. If you recall, in that report itself, certain things were mentioned regarding the current royalty regime. Number one, there was a clear recognition that the royalty regime is fairly new, and the Davis Tax Committee felt it needed time to really embed itself properly in the industry. The Davis Tax Committee also mentioned in its report that there's no need for any new instruments, typically a windfall tax system or a pure rent resource type tax system, to replace mineral royalties itself. But what the Davis Tax Committee actually recommended was that certain areas of the current royalty regime certainly need to be relooked at and to be refined. And it was really pursuant to those recommendations that we had the session towards the tail end of May. So really what was discussed there, a number of issues was discussed, but very much focused around some of the technical challenges in interpretational issues regarding the royalty regime. I must remind the listeners that the royalty regime is quite novel and unique, certainly one of the best in the world, many commentators will say, because it tries to combine two different elements. It tries to combine an ad valorem system, i.e. a system that taxes on the actual value, but at the same time also has got a built-in system that taxes output. So it combines the two systems that are generally available globally, and that's what makes it quite unique. What does it really mean for mining companies and for the fisc? It really means that when there's a lot more profitability, your royalties will be higher because it's got a profit element to the formula. But in times when there's zero profitability or very low profitability, then you find that the royalties are actually going to drop down. Because the system has got a floor system, i.e. it's got a 0.5 minimum royalty charge, it also means that where companies are not in a profitable position, there is still a minimum 0.5% of your actual turnover or gross sales that gets charged for the royalties. And in that complicated system, what we found over the past 6 years since the legislation's been in force is a number of grey areas, a number of areas which can be considered as anomalies in terms of interpretation, and that was the focus area for that session during the tail end of May.
And will it be a situation where they can deduct their expenses before what we call EBIT? Is that a given?
So that's just one of the areas of contention in terms of what expenditures are deductible. Maybe what I can do is take a step back and say that a novel aspect of our regime really goes on this concept of conditions specified. What is condition specified? It's really the first saleable point. In other words, each mineral has got different conditions specified based on its purity and its marketability, etc. And that really culminated in two schedules in the royalty legislation. Schedule 1 dealing with refined minerals, Schedule 2 dealing with unrefined minerals. And so the philosophy is really to tax you on the value of that mineral resource at that point of condition specified, i.e. at that first saleable point. Similarly, your expenditure then is also linked to that condition specified. So what the legislation really tries to seek to do is to say we will tax you on what you're extracting, what you're taking out of the ground, but up to the point what we believe is this first saleable point, i.e. the commercial point of sale. If you beneficiate beyond that point, it's not fair and we shouldn't tax you on that. But similarly, in claiming expenditure to get to the appropriate profit margin, we will therefore only allow you deductions up to that first saleable point. And in getting to both the gross sales as well as the EBIT number of the condition specified, there's a lot of grey areas. So let me give you an example. Head office costs is one of the areas of a bone of contention. Why? Because the taxman, certainly SARS, views certain of head office costs as not being up to conditions specified, because it may be related to head office costs for a sales or marketing function which is beyond the conditions specified, beyond the point when you've extracted the mineral. Many of my clients will say, but that's nonsense, because many of the head office costs are really related to functions performed up to conditions specified. Now, the legislation doesn't tell you at what point do you cut off things like head office costs. And so therein lies the anomalies, therein lies the uncertainties of what expenditures would form part of the EBIT, what not. Similarly, with regards to gross sales, another bone of contention has been that your expenditure, or rather, the income that you generate must be from the mineral itself. Therefore, when you sell your minerals and you've got a transport factored into that sales price. So a typical free on board sale price, for example, includes the fact that there's certain transportation cost that forms part of your sales revenue. Those costs should in theory be excluded from your gross sales. Otherwise you're taxing on the transportation element of the price you're recovering from your customer as opposed to the pure mineral itself. Again, in that situation, certain interpretations have been taken that only if your invoice, for example, clearly defines what portion is for the sales bit, what portion of the invoice is for the transportation bit, that you can then exclude that from the gross sales. If your invoice is not clear, the taxman has said, well, we will tax the entire gross sales amount, including the transportation costs. And those are the areas which cause massive uncertainty. And as you can imagine, in today's day and age, a huge part of the revenue that's earned from mining companies is because of the cost they incur for the transportation of that mineral to their customers. It's not right or fair to tax that. The legislation certainly doesn't seek to tax that. But the interpretation tends to lead to different conclusions. That's the other area of uncertainty. That's the other area where we are hoping that the Davis Tax Committee will refine and bring more clearer legislation in the next round.
And when is that next round due?
So if you look at the process going forward, what's going to happen is that a number of these recommendations have been made coming out of that workshop, clearly to a very receptive ear at the Davis Committee, I may add. What we're waiting now for is how those recommendations are going to culminate in actual recommendations in the next round of the Davis Tax Committee. We know that the first interim report was out. We also know that broader than just royalties, many other inputs were solicited from industry regarding the various other recommendations of the Davis Tax Committee. And the next round will be a further report. So that we'll get a second draft of that report, which I understand is fairly imminent. And I understand from the committee members that that's been postponed. There's been certain delays that's resulted in that second round report being issued. But I'm hoping that certainly by July, August, we should end up getting a second report. And it's in that second report that we need to now really dig deep and do a deep technical analysis of whether these points have been captured to provide the certainty that we want in the royalty regime.
And it's so important that we arrive at a competitive result. When you talk about a unique tax and a state-of-the-art tax, is it envisaged that we'll have competitive taxes?
Yes.
So that we can encourage investment?
Martin, I think what's happened is that clearly the very extensive consultative process leading up to the mineral royalties itself, as well as the period post the royalty, has given a broader acceptance within the community, within the mining community, that royalties are here to stay. And there's a very valid and legitimate purpose for the royalties. Nobody doubts that. When it comes to the question of competitiveness, what companies are rather looking for is certainty in the legislation. So they say, we will accept that we'll pay the royalties. We'll pay it at 0.5%, we'll pay it at 7% if we get to the profit position, if it's unrefined. We'll pay the 5% on gross sales if we are refined mineral and we're in a profit position. But how we get to the 5% is the uncertainty. And that is what industry is looking for. So if we can provide a lot more certainty in terms of these interpretation issues, I think it will add to a lot more competitiveness, because our investors will say, now we know exactly what the royalty charge will be should we meet certain profit targets. And that, I think, is going to be a good outcome.
And what, in your view, are the steps that the Davis Committee needs to take now to make sure that this uncertainty is removed?
I think it's been very positive, the interactions they've had so far with the industry. So certainly, hats off to them on that. So number one, I think continued engagement of the industry is going to be quite important. What we would hate is for all of the good input that's gone in terms of all the recommendations and discussions, and for that to fall flat. Unlikely, because we know the judge is very open-minded and very receptive to recommendations. So I think number one, a continued involvement of industry is going to be quite important. Number two, a clear need to go beyond just the technical aspects of gross sales and EBIT, etc., and to have a real hard look at those schedules, i.e. the area of when is a condition specified really arrived at, in light of real experience over the past 6 years. So let's refine that. That is the stuff of the geologists and the mining engineers, to really look at those schedules again and say, does that really fit the current regime? Does it fit the current state of the industry? And those are two or three of the key things I think we're hoping for will continue with the Davis Tax Committee.
And just take us back a bit, the history of this royalty tax. It's a relatively new tax. Can you tell us the background, why it was introduced, how it was introduced, when it was introduced?
Well, if we go all the way back, if you remember, when we had the Mineral Petroleum Resources Development Act, it was clearly indicated therein that there will be a levy that will be charged on the extraction of minerals. And that really became the founding principles that laid the groundwork for the royalty legislation itself. I may add that it took us up to 5 years pre-2010 in real hard discussions and negotiations with the various stakeholders to get to this fairly novel piece of legislation. And again, it was a very, very good process. I think by all accounts, industry was extensively involved. And we really moved from a system which was going to be one that was going to simply tax at a flat rate to one that was ultimately got to a position that balances both the profitability aspect by virtue of having a EBIT-driven formula, as well as a formula that at least gives a constant revenue stream through the 0.5% royalty rate, even in circumstances where you've got a zero profit position. And that was really the history. I mean, it was really extensive. There was mining engineers and mining consultants were involved in coming up with the condition specified schedules. And so, by all accounts, it's a fairly unique piece of legislation, state of the art in many ways, but one that obviously, once it's been in practice, has thrown up these interpretational issues. And hence, really now, a real great opportunity for the industry, for Treasury, for the Davis Tax Committee to re-look at it in the context of where we've come to over the past 6 years, in the context of where the industry is, and in the context of where do we want to take mining taxation in this country forward.
And there have been certain amendments now to the Income Tax Act.
Yes.
Will these impinge on this royalty arrangement at all?
So, Martin, I think what you're referring to is proposed amendments to the Taxation Laws Amendment Bill that was literally released about 2 weeks ago. And those amendments certainly do not address any of the issues that we've spoken about in terms of the challenges regarding the formula, etc., etc. Certainly none of the issues we discussed at that extensive workshop that was held in May. However, what is a bit disheartening is that the proposed amendments really strike at two particular issues. Number one, there's a proposed amendment that deals with the timing as to when you need to get your royalty return submitted. So let me take you back a few steps again. Simply an administrative issue is that with regards to royalties, there's a separate royalty return that taxpayers have to file in terms of when taxpayers meet the requirements of being an extractor of minerals. That royalty return originally was required to be submitted 6 months after the financial year of the taxpayer concerned. This 6-month period posed a challenge because it was not aligned with the income tax return of that taxpayer, which needs to be submitted at the end of the 12-month period. So what you found is that taxpayers were in an anomalous position in that they had to then get to a calculation of their royalty, the final royalty charge within the 6-month period post year end, without them having to have finalized the actual tax return. And as we know, the two systems are quite aligned to each other. So the royalty tax, for example, is still based on concepts related to taxable income, for example, or deductions which are allowable for purposes of taxation. So you need to know what those concepts are and what that really relates to when you're determining your royalty return itself. There was quite a lot of submissions and pushback from industry, and that was changed in the past to then align the submission of your royalty return with the income tax return, so that you could then have a 12-month period to complete both those returns and bring consistency between the royalty return and the income tax return. Certainly, I think I was caught quite off guard by the proposed amendment now, which seeks to bring back the timing of when that royalty return needs to be submitted back to a 6-month period post-year end, i.e. again, taking away the alignment that we so hard fought for. Now, what does that mean for taxpayers? Well, I think it puts you back in that same position where you are now forced to either upfront your income tax return, even though you've got a 12-month period, so that you can match the alignment of the royalty date, which now needs to be submitted within a 6-month period. Or you're going to again have that situation where taxpayers are going to be forced to do a royalty return which is not 100% accurate because they haven't gone and filed and gone through all the legworks of having completed their income tax return. So certainly what I would want industry to do is to make submissions on that particular aspect, to bring back that alignment which is currently in the legislation, not to take that away. And again, I'm quite keen to find out exactly what the rationale behind this is. I'll probably touch on what I think is the rationale, and that is that I think it's simply a tool that I think the taxman wants to try and upfront their data around the actual royalty collections themselves. And that touches on the second proposed amendment, which is being proposed by the TLAB, the Taxation Laws Amendment Bill. That second amendment seeks to now bring in a provision in our legislation which allows the taxman to ask you to justify an estimate of a royalty return that you make. So remember, you've got 3 provisional payments. The first is within a 6-month period of your financial year. The second one is at the end of the financial year, and you have a third provisional payment that happens after the financial year. So in that first and second one, typically taxpayers would make an estimate and say, I estimate that my royalty is going to be X amount and I'm paying so much based on that estimate. What the taxman now wants to do is when you make that estimate, they want the ability to challenge you on that estimate based on, for example, previous year's actual royalty charges. That's what they do for income tax. So income tax, what you do is if you submit a second provisional payment and they find that that provisional payment is actually quite different from your tax charge last year, they actually ask you to justify why there's been a short payment. And in instances can actually adjust that. That's exactly what they want to do for royalties. So what does it mean? It means that they want their money quicker with regards to the royalty payments. Instead of waiting for 6 months post-year end, they want you to pay that royalty much quicker. And if you look at that philosophy of bringing the money quicker into the coffers of the fisc from a timing point of view, that seems to be also the driver of now shortening the royalty the time by which you need to submit your actual royalty return from the 12-month period to the 6-month period, i.e. make your payment quicker, file your return quicker, so we can make a quicker assessment of whether you've actually paid the proper amount of royalties or not.
And if companies want to make submissions and representations around going back to the original idea you had for working out royalty values, etc., how long do they have now with this proposal coming through for changes to the amendments to the Act? So
Martin, there's clearly an opportunity to make submissions, which is typically what the Taxation Laws Amendment Bill requires, and very hard submissions are ones we need to make. Can't recall offhand exactly the timing, but I would suggest that industry gets the Act together and make those submissions as quickly as possible, because once the bill goes into the legislative process, then it's very difficult to pull it back. And typically the bill would be submitted now. You'd have till probably around end of August to make submissions. And then you'll find that the bill then ends up being published into Act and then typically gets promulgated towards the tail end of November, December. Once it's legislation, then we know it's very difficult to then change it without then having to go through the whole legislative cycle of having to change the act itself.
That was Creamer Media's Mining Weekly Online, talking to Mohammed Saluji, the Director and Head of Corporate Tax and Mining Tax at advisory firm KPMG.